Okay, we are back. I'm very happy to have Chris Cogswell here on the Goldstein on Gelt show. He actually spent years traveling around the world in Hong Kong and China. He's a money manager, been managing money for people since 2002. And in fact, Chris and I have something in common that we're both affiliated with a group in America called the Portfolio Resources Advisory Group. And Chris, as a money manager, give me a big picture. What do you do?
Effectively, we help people manage the assets that they don't have confidence in managing. So a client comes in the door and says, I don't quite understand markets. I need to, retire in X amount of years. I need to reach certain goals. Can you help me invest the money? And that's the short version of what we do.
So let's distinguish between a money manager and a financial planner, because I do think there's a distinction. Can you spell it out?
Sure. And the money manager at some point takes direction from a planner who sat down with a client, built a long-term plan, knows what their goals are. They're much broader than just manage this money. How do I want to invest my money to reach the long-term family goals that I might have? And so then the money manager takes direction from the client and the financial plan that has been built to put the investments in the right place as directed by the client and the planner to hopefully reach those long-term goals.
I think that is a critical distinction, and quite frankly, I found a lot of people don't get it. I consider myself a financial planner or an investment advisor, but I don't consider myself a money manager, meaning clients will come to me and say, "Hey, Doug, will you handle my money?" And so I say, well, what do you mean by that? I can help you design a plan, or we can talk to you about the investments, but I'm not the guy who's going to sit in front of a screen all day and do the market analysis and actually make the day-to-day market buy and sell decisions. That's what money managers are for. Is that a good way to describe it?
That's exactly right. And it is a particular skill set that has to be learned over a period of time. Experience always comes into it, in addition to sort of a technical skill set that's learned as well. And in your position, running a business day to day, dealing with clients face to face, it precludes you from sitting there, to your point, and managing the assets and watching them in the market and doing the analysis.
And I'll tell you, one of the funny things about it also is when individuals try to do it on their own, I'll often ask them, well, are you going to spend 8, 9, 10 hours a day focusing on the markets to manage your own money? And they go, no, I look at my statement every quarter. And I'm thinking, how can you manage money, right? You got guys like Chris Cogswell who literally, they are students of the market and they're watching it all the time. And of course, people pay for that service. And a lot of people say, well, what am I paying for? And the answer is you're paying for someone to actually do the work of managing the money. And hopefully he has a little more professionalism than you have.
And I want to highlight one sort of corollary to that, and it's this. There have been a lot of studies out there that show that individual investors, whether they manage mutual funds or whatever they may manage, but let's take mutual funds for a minute. You check the individual investor and their performance versus mutual fund managers and how those guys do, and the investors that use those same mutual funds, you'll find typically the individual investors do much worse than the individual mutual fund managers that they use. And it's because the individual investor has either a poor skill set, they just haven't been in the business per se, and they get emotional about it. And so they do things wrong at the wrong times in the market. The markets go a little haywire, they downturn, clients, investors get fearful, they pull out when maybe they should have bought in, et cetera, et cetera. So in fact, what you tend to do, at least guide them in, and what we do as money managers is we take the emotions out. And so that, in a sense, is where we really add value. When the markets do crazy things, we really make sure that bad decisions don't get made.
Yeah, I think that is so critical. And I'll tell you something that I think surprises a lot of people is that even for myself, though I consider myself well trained in the stock market and the bond market, and I can talk about funds and ETFs, and I know how to do the research. But for my own money, my long-term retirement money, 99% of it is managed by money managers, because I'm an emotional guy, and I don't want to be in a position where I have to make these major decisions and be affected by maybe how I'm feeling that day, or if I'm tired, or if it's late in the day, or if my wife and I have a different opinion on how to do something, which of course we never would, but if we did, I want to make sure it's handled by professionals. We're talking with Chris Cogswell, who is a professional money manager. He's been managing money for since 2002, and like me, he's an associate with Portfolio Resources Advisory Group. Chris, I want to talk about something, a new venture that you're getting started on. And earlier you said the word technical, and I know that the name of this portfolio has a technical name, but tell us about the name of the portfolio, and then let's break it down to understand exactly what this is and, in fact, why it's kind of revolutionary in the world of money management.
Sure. So the technical name is the Prag Managed Risk SRI Portfolio.
Okay, say it once more.
Prag Managed Risk SRI Portfolio.
All right, now break it down.
Prag is effectively, it's the firm that you and I are both affiliated with, Portfolio Resources Advisor Group. Managed risk is a concept of how to deal with the daily, weekly, monthly action of the market as it moves up and down, volatility. So we try to manage that, and I'll explain that in a minute a little bit more. And the second part of SRI means socially responsible investing. And what we're doing, and this is the most important piece to start with, is we are using socially responsible mutual funds in this portfolio, and we're pairing that with this risk management approach. And that's the very short version.
Okay, so let's break it down first about what is SRI. And when people talk about socially responsible investing, I'm going to take the cynics side of it because I really want to get a lot of this out on the table. A lot of people say, oh, it's just a marketing ploy. Get the people who like, the environment or like the animals or like whatever, and let's get them investing too. So we'll call it SRI. Is that what it's really all about, or is there something more sincere?
I think there's definitely something more sincere. And again, I'll refer back to my career as an analyst when I looked at and analyzed companies regularly, and bring that to this discussion. And that is, companies that typically what we would say apply environmental, social, or governance screens, which are the ones that are used in SRI, they tend to have less risk involved with them. They tend to perform, or at least certainly competitively, but they have a little bit less risk involved. And those, from my standpoint as a money manager, are critical things.
Sorry, why would they have less risk?
Well, for example, let's take environmental. There's, again, three categories of screens: environmental, social, and governance. Well, from an environmental standpoint, if you have less lawsuits because you're polluting less and because you're a good sort of community member and so on and so forth, that does potentially impact how you do as a business. Let's talk about governance issues. Do you have strong corporate policies at all of your different board levels, audit committee, management committee, all of those sorts of things? Are you going to face lawsuits from outside? Those sorts of things. So it does tend to lower the risk of companies that think about and operate in an environmental, social, and governance capacity.
Okay, so now let's go to the second step of this, which is the managed risk side. If you're owning stocks, which in any field, and no matter how safe the companies are in terms of not getting sued, obviously the market's always there and that can do some damage. What do you do in order to hedge that risk?
Well, prior to 2008, what everybody did was you invested in a range of different types of stocks and bonds, right? What we call asset classes. So you would have a large, a mid, or a small cap stock, some international, maybe some emerging market stock, and you built a diversified portfolio with that. That was what pretty much everybody did. And then 2008 taught us two things. One is that the way those asset classes moved together was starting to move more closely together as opposed to being diversified. And so that was a problem, and we still deal with that. The second thing about 2008, and this was the really critical one, was we found that portfolios that had a lot of different asset classes that were diversified well, in fact, except one or two asset classes, they all did poorly. They all moved in the same direction, and they were all bad. They went down. So this is where the need to add a risk management approach to a normal diversified portfolio came from. So that's kind of how we got here.
Okay, so you've defined the pain point, and now tell me what your solution is.
The solution basically is, in this particular portfolio, is applying what we refer to as a volatility approach, a risk approach. And so we look at if the risk is increasing in the market or decreasing, and depending upon how that's going, we will increase the conservativeness of the portfolio, in other words, decrease the risk, or we will move to, if the risk in the market is lower, we'll increase sort of the aggressiveness of the portfolio. So we move back and forth depending upon how we see the risk level in the market.
And how can you tell?
Well, our partner in this venture is Milliman, and they work very closely and manage risk for very large insurance companies globally. And what they do is, in their global offices, is 24 hours a day, is they look at key economic and market indicators that relate to what we call volatility. And volatility simply is just the movement of the market up and down daily, weekly, and monthly. And as they see those factors increasing, they lower the risk in the portfolio. They move it more conservative. If they see those things decreasing, they'll move it more aggressive.
So when you say more conservative, that just means selling off positions and going to cash?
Yeah, they move more to cash in the portfolio.
Interesting. So you've really got two things going on here, and I just want to wrap up with this because we're just about running out of time. But you've got the model of SRI investing, socially responsible investing, which, as it sounds to me like you're describing, has two benefits. One of them is that if you are in fact interested in socially responsible investing, then this is the type of thing for you. But also fundamentally, you're saying that those companies might have a lower risk. Is that part A?
Yes.
And then part B is that in order to protect the investors from the swings of the market, you're working with a company which has expertise in managing risk, and hopefully they're able to identify when the market is getting riskier in order to lower the exposure of the portfolio.
That's correct.
And I guess we'd always have to say that past performance is no guarantee of future returns, and a portfolio like this is not for everyone. What type of people would be interested in this sort of portfolio?
Obviously, people that want to, I don't want to use the word necessarily to protect, but want to sort of limit the risk they're taking in the market. In other words, these are the assets that we feel should be a little bit more conservative. That's first and foremost. The second is, at a certain point, you can think of it as, if you will, and you'll understand this, the core piece of your portfolio. This is maybe the central piece. So, again, part of what the portfolio is designed to do is help you get more of the equity type returns, the growth returns, but with lower risk on the downside. So it actually can be for a lot of clients that need it as a core holding.
Okay, so interesting. And again, I'm just going to note for all the listeners out there that there's no such thing as the perfect investment that only goes up and never goes down. But it sounds like there's a lot of intelligence going behind the management of this in order to try to design a system so that we can, hopefully be in a portfolio that will mitigate the risk. And as you're saying, Chris, as a long-term core portfolio, risk is an essential thing to be concerned about, and you want to make sure that you're setting yourself up in an intelligent and diversified portfolio.
And that's correct. And I like your word mitigate. Mitigate risk is really what we're trying to do here. And again, and that is, I think, goes very well with the fact that we're working with a partner in this who does effectively that. They manage risk for large insurance companies globally.
All right. Sounds great. We've been talking with Chris Cogswell, a money manager. Chris, in the last few seconds, just tell us, how can people follow you and follow your work?
The website to go to is the Portfolio Resources Group website, and that is prginc.net.
Okay, and we'll put a link to that at the show notes of today's show at goldsteinongelt.com. Chris Cogswell, thanks so much for your time.
Appreciate it, Doug. Thanks for having me.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world. If you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.